Hello everyone and welcome back to Simplify Quant. In today's video, we'll discuss how to evaluate trading strategy effectively. Whether you are a seasoned trader or a beginner, these metrics are essential to understand the performance and risk of your strategy. Let's dive in. Over performance metrics, total return. This is overall return of a strategy for over a specific period of time. Annualized return. This is the most important thing that a person can look when evaluating the strategy. It converts the total return into a yearly equivalent, making it easier to compare strategy over different time frame. So why it is one of the most important parameter. By looking into the annualized return, one person can know whether that strategy is performing over the benchmark. Suppose you are trading in stocks and the annualized return is less or equal to the risk-free rate. So it is so so the person will not opt for the stock market strategy because it is risky and it is giving less return. So annualized return give you the idea like how well it is performing over the risk period or any benchmark. So person can take decision and invest in that strategy. Annualized standard deviation, that is the volatility of the strategy. So it measures the strategy risk by calculating average deviation of return from mean on an annual basis. Annualized Sharpe ratio, it evaluates risk adjusted return by comparing the excess return of strategy to its volatility. So it tell you like how much risk you will take, what amount of return the strategy can be. Generally, over one or over one Sharpe ratio is better for the strategy. Similarly, these are the annualized return and standard deviation. Similarly, you can calculate the daily metric also, like daily mean return, average standard deviation, and average Sharpe ratio. That give you an idea like how well the strategy is performing on an average basis. Now let's look into the risk metrics. If you have a daily written time series of the strategy, you can get to know what is the worst day of the strategy. It identifies the largest single loss in the strategy. This metric highlights the extreme risk and it is useful to understand the tail risk of the strategy. The next is the maximum drawdown, MDD, the largest peak to trough decline of a strategy value. The other is the percentage of positive days, the ratio of profitable trading days to total trading days expressed in percentage. That give you an idea like how much percentage of days the strategy can have, how much number of days the strategy is in the positive range. The other metric is the benchmark metric, that correlation with indices. It measures how closely the strategy returns track a benchmark index. The beta indicate the strategy sensitivity to market movement. Alpha represent the excess return over the market benchmark accounting for risk. To give an example, like why benchmark metrics is very important. Suppose your strategy benchmarking some indices and the strategy return is say X%, but the benchmark rate is X plus 1%. So you can get to know like how the benchmark is performing, whether the benchmark is above the strategy alpha or below the strategy alpha. If the strategy alpha is negative, so there's no need to put money on the strategy. You can simply like put money in the benchmark indices. Why benchmark metrics is important? Because it tells us like how your strategy is performing with respect to the benchmark. So if the strategy is performing below the benchmark, so there is no need to invest in the strategy which is performing below the benchmark. You directly invest in the benchmark indices. There are advanced metrics to evaluate the strategy, such as Kalman ratio, which has like compare the annualized return to maximum drawdown, win to loss ratio, the ratio of profitable days to losing days, turnover ratio, and the rolling metric. Rolling metrics is like rolling Sharpe ratio for certain period of time, rolling volatility for certain period of time. So evaluating trading strategy is not just about profit or about high returns. It's about understanding the risk, consistency, and alignment with your financial goals. Using these metrics, you can get a holistic view like how the strategy is performing. And whether you want to invest in a strategy or whether you don't want to invest in a strategy, you can take a decision. I write blogs on quantitative finance and my website is www.simplifyquant.com. In that, we have different sections. In one of the sections is Python code, where I have performed these parameter and many more parameter on Nifty index. The code will provide you all correlation matrix, maximum drawdown, the various types of ratio, and many others. The link is provided in the description. You can go to the link and use that Python code to evaluate your asset class or your study. Thank you for watching the video. See you in the next video.